Hey everyone, and welcome. Today we're going to do something a little different. We're going to use a huge real-world corporate drama to learn 20 must-know business English words. So forget the boring textbooks because this is a vocabulary lesson where literally billions of dollars are at stake. Let's get right into it. Just look at that number for a second. $6 billion. That is the unbelievable amount of money at the center of this massive legal fight between, one of the most famous brands in the world, Coca-Cola, and the US government's tax agency, the IRS. So that leads to the obvious question, right? How on earth does one company end up owing that much money? Well, the answer isn't simple. It's kind of hidden inside some very specific business and legal language. But don't worry, by the end of this explainer, you're not just going to understand this one case. You'll have the vocabulary to understand a whole lot more. So here's our game plan for today. First, we'll get into the language of law and taxes. Then, we'll look at the words that describe how these giant global companies are actually put together. And finally, we'll get into the really tricky ideas of assets and value. Ready? Let's go. Okay, part one. Let's jump right into the legal battle itself. To really get what this fight is all about, you have to speak the language that the lawyers and the accountants are using. All right, if you remember one term from today, make it this one. Transfer pricing. Let's say that again. Transfer pricing. This is a huge concept. So what is transfer pricing? It's all about the prices that different parts of the same big company charge each other for goods and services. And boom, there it is. This is the whole case in one sentence. The US government basically argued that the prices Coca-Cola in the US was charging its overseas branches, well, they weren't fair. They claimed it was a strategy to pay less tax in the United States. So how does a disagreement like this play out? Well, it usually kicks off with an audit. An audit is just a formal investigation. Think of it as the tax authorities taking a very close look at your books. If that audit finds something they don't like, it can lead to a tax court ruling, which is where a judge makes a legal decision. But what if you don't agree with the judge? Well, then you start appealing the decision. Appealing the decision just means you take your case to a higher court, hoping for a different result. So the big accusation from the IRS was that Coca-Cola had underreported income. Let's repeat that, underreported income. They were essentially saying, hey, you didn't tell us about all the money you really made. And that claim of underreported income is exactly what led to that giant $6 billion tax bill. This case is a great example of something happening all over the world. Tax authorities are really scrutinizing global companies. To scrutinize means to look at something very, very carefully, almost with a magnifying glass. And they are absolutely scrutinizing how these big companies move money around the globe. Now, this brings us to a super important point. The government wasn't necessarily saying Coke did something illegal. They were talking about aggressive tax avoidance. Now, tax avoidance is when you use legal rules and loopholes to lower your tax bill. It's technically legal, but it's this kind of legal tax avoidance that governments are always trying to crack down on. All right, let's move on to our second section, because to really get this whole transfer pricing thing, you kind of need to understand how these huge global companies are actually built. Coca-Cola is, of course, a perfect example of a multinational corporation. Say it with me, multinational corporation. It's a bit of a mouthful, I know, but all a multinational corporation is a very large company that does business in many different countries all around the world. Now, these giant companies aren't just one big blob. Nope. They're made up of lots of smaller companies that they own, and we call those subsidiaries. Again, that's subsidiaries. So you can think of Coca-Cola in the US as the parent company, and Coca-Cola in, say, Ireland or Mexico as its subsidiaries. So what happens when these different parts do business with each other? Like when the US parent company sells its secret syrup to its Brazilian subsidiary. Well, that's called a cross-border transaction. Makes sense, right? It's a transaction that crosses a border. Any deal between companies in different countries is a cross-border transaction. A slightly more specific term you'll hear is intercompany transactions. That's intercompany transactions. These are the deals happening inside the same big corporate family. And these are the ones that tax authorities watch like a hawk, because the prices set for these intercompany transactions basically decide how much profit and how much tax gets paid in each country. Okay, so we know who is doing the buying and selling, but what's really wild is what's actually being sold. And this gets us right to the core of the problem in the Coca-Cola case. How do you put a price on something you can't touch? You see, the most valuable thing Coca-Cola owns isn't its bottling plants or its delivery trucks. Not even close. It's their intellectual property, or IP for short. Again, that's intellectual property. We're talking about the brand name, that famous swooshy logo, and of course, the secret formula. The whole fight was about how much the subsidiary should have to pay to use this incredibly valuable intellectual property. So, how in the world do you decide what a fair price is? Well, the global standard is called the arm's length principle. It's a funny name, right? The arm's length principle. The idea is actually pretty simple. The price between two parts of the same company should be the same price as if they were two totally separate companies negotiating in the real world. The IRS basically said Coke's prices failed this arm's length principle test. And this, right here, is where things get so complicated. You have to understand the difference between two types of assets. On one hand, you have tangible goods, things you can touch, like bottles or sugar. It's pretty easy to figure out a price for those. But on the other hand, you have intangible assets. These are things you can't touch, like the value of the Coca-Cola brand itself. How do you put a price on that? It's incredibly difficult, and it's why these massive fights happen. Now, to try and bring some order to this chaos, most countries have codified the arm's length principle into their tax laws. To codify something just means they've written it down and made it an official systematic rule or law. So this isn't just a vague idea, it's a codified part of the legal system. But, and this is a huge but, even though the rules are written down, the real-world situation is almost never clear-cut. The answer isn't obvious. When you ask people how to value a brand name, there's no single clear-cut formula. It's often described as being more of an art than an exact science, which of course leaves tons of room for disagreement. Phew! Okay, let's pull all of this together. You have just learned the absolute key vocabulary you need to understand one of the biggest and most complex tax cases in recent history. Pretty cool, right? So let's do a quick recap of the biggest words. We learned that multinational corporations are made up of subsidiaries. They use transfer pricing to sell things between themselves. A huge part of this is figuring out the value of intangible assets, like their intellectual property, and they're supposed to do all of this by following the arm's length principle. If you can remember these 6 concepts, you're well on your way. And that's really the point, isn't it? This story was never just about Coca-Cola. This exact same language applies to companies like Google, Amazon, big pharmaceutical companies, pretty much any major global business. You now have the vocabulary to look at the world of international finance and really start to understand what's going on. Thanks so much for joining me for this explainer.